Alright, I will answer the question you came here for. Will SCHD make you a multi-millionaire? But before that, unlike a lot of other people who tell you to invest in it, I will give you what the sensible and rational viewers came here for. And that is a deep dive review of the ETF. SCHD has exploded in popularity lately, and today we'll explore whether that's some social media trend, is the fund really that good, or is this just a huge evil marketing conspiracy of Schwab? I will explore how it is constructed and what strategy exactly are you buying when investing in it, what is the historical performance, the sectors which the fund invests in, and the implications of that for your portfolio. Who is this ETF for, who it is not for, and finally, how much money are you projected to make if you decide to invest in SCHD. The Schwab US Dividend Equity ETF, or SCHD, is an ETF managed by Charles Schwab and was created in 2011. For those that are new to investing, ETFs are basically a basket of companies following certain strategy and methodology. SCHD has a very low expense ratio of 0.06%, which means that if you invest $10,000 in it, you will only get charged $6 per year, which is great. It is one of the bigger ETFs out there with $47 billion of assets under management. Alright, these are all things you probably know already or can easily check. Let's move to the meat of the video. The most important part of any ETF review is to understand the underlying strategy and methodology that it uses to pick the stocks. And ironically, almost no videos I have seen on SCHD actually do that. But I believe this is vital, and so I can't look at a fund without doing it, and it is also something I repeat to my students in the Dividend Method program, as well as in other videos on the channel. You cannot invest in ETFs without knowing how the fund is constructed. Well, actually, you can, but you'll be doing it blindly. So, what is the strategy of SCHD? If we check the Charles Schwab website, we will see it follows the Dow Jones US Dividend 100 Index. From here on, you need to research the index and what it does, or otherwise you are blindly throwing dollars at Schwab. A quick search on Google for the index will probably lead you to the website of spglobal.com, where we can learn more about it. There it says that the Dow Jones US Dividend 100 Index is designed to measure the performance of high dividend yielding stocks in the US with a record of consistently paying dividends selected for fundamental strength relative to their peers based on financial ratios. Okay, that sounds impressive, but it's not enough. We need to check the methodology, and we do that by clicking on this part of the page. When we open the methodology and search for the name of the index, we come across this page. And yes, I know it looks scary, but don't worry, I will make it very simple for you. So let's dive into how SCHD actually works. The first thing we see is that the index SCHD follows includes only USA companies, and it excludes REITs, which stands for Real Estate Investment Trusts. Whether the exclusion of REITs is good or bad is something you need to decide for yourself, but my opinion is that it is unnecessary and it drags down the total yield of the fund. The reason is that the REITs have, on average, higher dividend yields due to the way they are structured, and so there are perfectly healthy companies in the sector with dividends of 5 or 6%, which is something rare in the other sectors. So, right here is something that, in my opinion, could be improved by adding companies that are totally fine, pushing up the average yield. Okay, so this is the first layer of filters. From the stocks that remain, all must pass the second layer of filters. The first one is that all stocks in the index must have minimum 10 years of consecutive dividend payments. This is a great start for a dividend-oriented investor because it screens for companies with consistent dividends, commitment to shareholders, and disciplined management. The second filter is that all stocks must have at least $500 million in market capitalization. FMC stands for float market capitalization. This is also, in my opinion, good because it screens for bigger companies which are more likely to be more stable and mature. The third filter is the average daily value traded. It basically screens for companies which have enough liquidity, which is also something positive because that means that the ETF managers won't be stuck with a company that no longer passes the criteria just because they can't sell it in the market. Okay, are you with me here? These are the filters in the second layer of the screening of the index. Once the stocks have passed the first and second layers, those and only those that remain are subject to ranking based on indicated annual dividend yield, which is what IAD stands for. Now, this is an important feature of the index that has huge implications So bear with me. The stocks are basically ranked for their yield in a descending order, meaning the higher yielding stocks are ranked first. And here comes the important part. Then, after the stocks are ranked, only the top half, meaning the higher yielding ones, pass the third layer of selection. This here is something that shapes the structure of the index and SCHD and is probably the most important thing to understand. This third layer means that SCHD by design will probably never include lower yielding, higher growth names like MasterCard, Visa, or big tech stocks like Microsoft, Apple, or Nvidia that all currently have less than 1% yields, regardless of the fact that they pay a dividend. Whether that's good or bad, it's up for you to decide, but you need to be aware of it before investing in SCHD so that you can make an informed decision knowing that the ETF probably will never hold the hot tech stocks that you can see in the Nasdaq. Okay, so up until now we have been talking about layers of screening that exclude stocks from the index. Let's recap. First layer is stocks that are part of the Dow Jones US Broad Stock Market Index, so only stocks from the USA are there and there are no REITs. In the second layer, only companies with 10 consecutive years of dividends, minimum size of $500 million and enough liquidity are allowed. And then in the third layer, the remaining stocks are ranked by dividend yield from biggest to smallest, and only the top half survive. After all these three layers have been applied, then the final composition of the SCHD ETF is created by a ranking of the remaining stocks using 4 metrics that are vital for you to understand if you want to invest in the ETF. So, I will go through them one by one here with you. The first metric is free cash flow to total debt. This basically means that the index screens for level of indebtedness by comparing the cash that is left as profit for the company to the debt it has. The higher the ratio, which means the higher the free cash flow and the lower the debt is, the higher score the company receives. I generally like this filter because it screens for companies that have healthy levels of debt and which are more likely to have no issues to cover the interest payments with their profits. However, this metric has 2 drawbacks as a screener. The first is that it doesn't take into account that some industries and sectors are very debt heavy and others not so much. So it will exclude otherwise good companies that have a perfect healthy level of debt compared to their peers in the industry. The second drawback is that it skews the index in favor of companies that pay their expenses by cash or by raising equity instead of taking debt, which is not necessarily always the smartest thing to do. Okay. The second metric is return on equity, described as net income divided by total shareholders' equity. This is an important metric that I use in my stock analysis and that I also teach my students in the Dividend Method program to use when they are analyzing stocks. The same metric is used by Warren Buffett and he described it as an important factor he looks for when I read a book about him. The reason I like this metric is because it shows the efficiency of the business. The formula for the metric is the net income or profit of the company divided by, to put it plainly, what the company is worth if we get all the liabilities it has, which is what they owe to others, and subtract them from their assets. So, for example, if a company makes $1 billion in profit per year, its total assets are 10 billion and the liabilities are 5 billion, then we have 1 billion divided by 10 minus 5, which is 1 divided by 5, which means 20% return on shareholders' equity. Now, the drawback I have found in this metric is that sometimes a company might have very high debt load, which makes the net worth of the company a low number, which then gives you a very high percentage of return on equity when divided by net income. However, this is why you never look at metrics in isolation. The positive here is that the first metric, the free cash flow to debt ratio, already screens for companies with lower debt. So these 2 metrics combined overall work great together in my opinion. The third metric is the indicated annual dividend yield, which is basically the dividend yield expressed as the dividend as a percentage of the share price of the company. Nothing complicated here. And the fourth and final metric is the 5-year dividend growth rate. Again, nothing complicated here. How much has dividend increased in the past 5 years? So these 4 metrics create a so-called composite score. That composite score gives each metric equal weight, meaning all 4 of them are equally important. When the composite score is calculated, the companies are then ranked according to it, and the top 100 stocks are included in the index. After that, we can see there are a bunch of rules which are not important. The only thing worthy of mentioning is that if two companies have the same score, the one with the higher dividend yield will be chosen, which again adds to the importance of the dividend yield for the ETF and drives the fund's yield higher. Alright, now that we have selected, screened, and ranked the companies, there is one last thing worthy of our attention, and that is the diversification rules. As we can see, the index SCHD follows has a rule that says that no stock can represent more than 4% and no sector more than 25% of the index. I personally like these rules a lot as it avoids concentration in one or two companies like you get with other ETFs. For example, Apple and Microsoft being 50% of a technology index, or Exxon and Chevron 40% of an energy index. I think that's a good thing because people usually buy ETFs for diversification, and if they wanted to concentrate their capital in a few stocks, they would have purchased these stocks directly, avoiding unnecessary fees. So the 4% and the 25% rules are great ways to ensure enough diversification. Alright, if you stuck with me so far and paid attention, then congratulations, you are ahead of 90% of investors out there who blindly put their money somewhere because a talking head on social media told them to. I'm amazed how many people recommend SCHD and don't even bother to explain to their viewers the basic details of how the fund is actually structured and what strategy it follows. I want my channel to be different and to provide you with valuable investing education, not simply quick superficial videos that get views with the goal of making money from ads. This is not why I started it, and I hope you appreciate it. If you do, let me know by clicking the like button, and also subscribe to the channel by clicking the subscribe button and then the notification bell. That way, you will be directly notified when I release new videos instead of relying on the algorithm to show them to you. Thank you very much, and now let's move on to the next thing we need to discuss: SCHD's age and performance. I already told you the fund was created in 2011. The reason I'm bringing this up again is that it's important to understand the creation time relative to what was going on with the economy then. Now, when it comes to being a proven fund, 12 years is a lot of time, and so it is relatively safe to say that SCHD has been a battle-tested ETF. However, the inception date brings one major disadvantage that you always have to have in mind when looking at the performance. It was created after the great financial crisis had already happened and the economy was entering recovery mode. This is something you always need to pay attention to. If you compare two funds solely on performance, and one was created in 2010 and the other in 2006, then bear in mind that the older fund might have lower annual performance because it will have taken a major hit during the financial crisis. And so that means that the funds might be equally good, but the one that is from 2006 might have worse performance because it includes a major bear market in its history. It is basically like the difference between buying real estate in 2006 versus buying it in 2011. For SCHD, the current total return since inception is 291.32%. The 10-year annualized return is 11.05%, which is pretty good. Now, I assume that if you are interested in SCHD, you are mainly so for the dividend income and appreciation it provides. And in that field, SCHD really shines with 10-year dividend compounded annual growth rate of 11.11%. Of course, no one knows if that will continue, and we can see that for the past 12 months the growth rate was 5.7%, but it is a good track record. Speaking of the last 12 months, the share price performance of the fund for that time frame is currently at 4% up. Since I'm a cash flow investor, I am not that interested in the share price fluctuations, but for those of you that are, you might have seen the ETF compared to the S&P 500, which is up 15.65% the last 1 year. Now, by the time you watch this video, all these stats would have changed, so they don't matter that much. But the reason I'm showing you all this is to illustrate a point and to make you understand that comparisons like these are totally meaningless. Why? Well, because the two ETFs have different goals and methodologies. A person doesn't buy SCHD for the same reason they buy S&P 500. And for everyone who tells you that SCHD is up or down compared to the market, well, don't listen to them. Regardless of when you are watching this and what the situation is currently, this is true. S&P 500 is not the market. The index returns are driven mainly by a handful of big tech corporations that have currently seen their share prices explode, mainly because of the AI narrative. This has been true for years now and will probably be true for years ahead, regardless of whether the AI craze fades away, intensifies, or something else takes its place. So to compare SCHD to S&P 500 is like comparing apples to oranges. They are just different because they are constructed differently with different sector allocations and are used for different purposes by investors. Which brings me to the next stage of our research of SCHD, the sector breakdown. The main reason SCHD has underperformed recently, and for those listening 2 years from now, recently means by the end of third quarter 2023, is the fact that, as you can see, it has only 11.6% of the technology sector in it, which has been the main sector driving markets up in recent months. In contrast, this sector is the biggest component of the S&P 500, hence the underperformance. But I am getting ahead of myself. Let's do a quick review of the sectors SCHD is invested in and what that means for the fund and your money in a descending order. Have in mind that by the time you're watching this, the percentages and even the order might have changed, but the description of the sectors and what each one means for you as an investor will stay the same. The first sector is industrials. The industrial sector is comprised of companies involved in manufacturing and distribution of goods and services related to industrial production. It includes companies that make and provide things like machinery, airplanes, and construction and transportation services. Their performance tends to correlate with economic cycles. So during economic expansions, the increased business activities, construction and infrastructure development, etc., drive growth in this sector. However, industrials can be vulnerable during economic downturns when demand for industrial products and services decreases. So basically, it is one of the sectors considered cyclical. Its performance is closely tied to the overall health of the economy, and it tends to do well during periods of economic growth, but may struggle during recessions or economic contractions. Big companies in the industrial sector are Caterpillar, UPS, Boeing, and others. Having this sector as top sector in SCHD is a double-edged sword. It is great because during good times it will probably contribute to good results for the ETF, and it means that the fund will benefit from the onshoring trend in the USA. However, it also means that the earnings of the companies in the top sector might suffer a lot during a recession, which will mean weaker growth for the ETF. Next is healthcare sector. The healthcare sector includes companies that make medicines, medical devices, and provide healthcare services. For obvious reasons, healthcare is primarily considered defensive, which means the profit of the companies is not affected as much by recessions. Its products and services are essential, and the demand tends to stay the same regardless of economic conditions. Obviously, if you are sick, you still take a pill, and you don't care if that means that you're not eating out tonight, right? Big companies in this sector include United Health Group, Johnson & Johnson, Pfizer, and others. I generally like seeing this sector as a bigger part of an ETF because, as I said, the companies there have fairly consistent earnings regardless of the economic conditions. One thing I don't like about healthcare is that the pharmaceutical industry relies a lot on patents. That means that a company can be on the top of the world this year but have its profit reduced by 30% next year because they are no longer the only producer of a certain drug. That risk, however, is reduced when you own a bunch of them in an ETF. Okay, next, financials. The financial sector includes companies related to banking, insurance, investment, and financial services. These companies provide services such as loans, savings accounts, insurance policies, investment opportunities, asset management, etc., etc. The financial sector is generally considered cyclical because its performance is closely tied to the broader economy, and it tends to do well during periods of economic growth, but may face challenges during economic contractions. This is because during economic expansions, banks tend to see higher lending activity and profitability, while investment firms benefit from increased investment activity. However, this sector can be vulnerable during economic downturns, especially if there is a financial crisis because of reduced economic activity, loan defaults, and falling asset values, all of which impact financial companies negatively. Big companies in the sector include JP Chase, Visa, Morgan Stanley, BlackRock, etc. I am personally pretty neutral on the sector, and so I don't see it as good or bad thing to have it in the ETF at this percentage, but I think the financials are very vulnerable to both regulation and technological changes. This combined with their cyclical nature makes me not want to see them go over this percentage of the fund. Next one, consumer defensive, also known as consumer staples. The consumer staple sector includes companies that produce everyday essential products that people use regularly, like food, beverages, cleaning supplies, tobacco, and basic household items. Consumer staples are considered defensive because people need these products no matter what the economy is like. I mean, you still take a shower and use soap regardless of whether there is a recession or not, right? Right? Big companies in the sector include Procter & Gamble, PepsiCo, Coca-Cola, Unilever, and others. I personally like this sector a lot, and I like to see it as a bigger part of the ETFs I invest in. It is very resilient and gives you a steady growing stream of cash without a lot of volatility. For that reason, I have a lot of companies from it in my portfolio. Speaking of that, to check my top 4 ETFs and stocks I invest in for the current environment we are in, go to the link in the description and I will send them to your email for free. The report will always be up to date regardless of when you are watching this because I am constantly updating it. Next sector, technology. The technology sector includes, surprise, companies involved in developing, manufacturing, and selling technology-related products and services. Businesses in the sector create products like smartphones, computers, software applications, internet services, semiconductors, etc. The technology sector is usually considered cyclical as it can experience ups and downs with economic cycles, but it often provides opportunities for long-term growth due to the technological innovation. On top of that, some of the companies in the sector are so big and have basically a monopoly or duopoly on a certain market that even during recessions their profits are relatively safe. Big companies in the sector are Apple, Microsoft, Nvidia, and others. This sector is the biggest component of ETFs like the S&P 500 or the Nasdaq 100, and you can see that it is currently only around 11% of SCHD. Having in mind the recent developments in AI and the growth of a few big tech-related stocks, it is no wonder that SCHD has underperformed these ETFs. However, that doesn't necessarily make it a worse investment. It is just a different ETF created for a different purpose. The technology sector is not known for its big dividend yields or dividend-oriented policy because these companies need to reinvest a lot of their capital into developing new technology to stay competitive. Hence, you won't see it as a top sector in a lot of dividend-oriented ETFs, regardless of the fact that it is the biggest sector in the economy. Okay, next one, energy. The energy sector involves companies that produce and distribute energy resources like oil, natural gas, and electricity. It includes industries such as oil and gas exploration and production, renewable energy, energy transportation like pipelines, etc. The oil and gas industry's performance is closely tied to the price of oil and gas and also to the demand for these resources, and so is highly cyclical. When the economy is slowing down, factories produce less products, people travel less, and so oil and gas companies make less money. So in general, the sector is considered cyclical. An exception to that are the pipeline companies, which offer a lot more predictable cash flow due to their long-term contracts that are often not connected to the price of oil and gas. However, sometimes their cash flow is dependent on the volume of the products going through their pipelines, meaning that if the demand slows down, they will suffer too. Major companies in the sector include Exxon, Chevron, Shell, and others. Unlike what the ESG crowd wants you to believe, these companies are not inherently bad and their business isn't going away anytime soon in the next decades, so I feel pretty okay with them being such part of the ETF. The next sector is consumer cyclical, also known as consumer discretionary. The name pretty much explains it. The consumer cyclical sector includes companies that provide products and services considered non-essential or wants rather than needs. Think luxury items, travel, entertainment, etc. Consumer cyclical companies are, surprise, highly cyclical, meaning their performance is closely tied to economic conditions. During economic expansions, people tend to spend more on discretionary items, benefiting this sector. However, during economic downturns, consumers cut back on discretionary spending, impacting the sales and profitability of the companies. Big companies here include Amazon, even though I personally think it is a technology company, but whatever, Tesla, Nike, etc. For me, being a more conservative dividend investor, I don't like to have this sector as a big percentage of my ETFs. However, it provides a good opportunity to take advantage of a booming economy coupled with high consumer confidence, so this percentage of SCHD being in cyclicals is fine with me. The next sector is communication. The communication services sector includes industries such as telecommunications, media, including social media, broadcasting, and others. The communication is not classified as a typical defensive sector. However, it is less cyclical than most of the others because it provides essential services. Regardless of whether there is a recession or not, very few people nowadays can stay even a day without phone and internet. So the demand for their services is pretty stable. However, the companies need to adapt to constant change in the technological environment. For example, a business like AT&T might have been the biggest business in the sector 1 decade, but then social media comes along and suddenly Meta is a far bigger company because of a profound technological change. Alright, don't worry, only 2 more to go. Next sector is basic materials. The basic materials sector is comprised of companies that produce materials. It includes industries such as mining, chemicals, forestry, and metals. The sector is highly cyclical, meaning that its performance is closely linked to economic cycles. During economic expansions, there is increased demand for raw materials in construction, manufacturing, and infrastructure development. Then, during recessions, companies can face challenges when demand for these commodities decrease because of less economic activity. Also, businesses in the sector are highly sensitive to the price of commodities, which adds additional volatility to them. You can often see companies with very high dividend yields in this sector, but you have to be ready for them to get cut by 40% next year and then go up by 60% in 3 years. Big companies include Rio Tinto, BHP Group, Glencore, and others. The sector is not for investors who rely on dividends to pay their bills. Because of that, I'm generally cautious with it. However, it plays a vital role in our society that is not going away, and arguably with the push for green energy, the basic material companies will only get more important. Because of that, I would personally like to see this sector a bit higher in an ETF than it is in SCHD. And the last one, utilities. Well, what can I say about utilities? We all pay them, none of us can go without them. The utility sector includes companies that provide essential services related to electricity, gas, and water. The sector is considered defensive and stable because it provides essential services that people and businesses need consistently, regardless of economic conditions. Demand for utility services remains relatively constant, making the sector less sensitive to economic ups and downs compared to other sectors. As an income investor, this is why I like to see a bit bigger allocation in it. However, have in mind that this is one of the slowest growing and most regulated sectors of the economy, so don't expect wonders from it. It's a slow and steady cash cow that will generally keep you afloat during bad times and luck during good. So, there you have the sector breakdown for SCHD. I always look at this whenever I'm thinking of buying an ETF, and in my opinion, without doing such an analysis, you are putting your money in the fund blindly, not knowing what to expect. At one point, the fund will underperform some other ETF, you will not know why, and you will panic sell. If you stuck with me this far, then congratulations. You have proven you are a serious investor who actually wants to know what they are buying. As I said previously, the reason I did such a deep dive is so that you know what actually you're putting your money in. The ETFs are not some magical financial vehicles that exist somewhere in ether. They are basically a strategy and methodology that results in a particular combination of sectors and companies. I did a deep dive on the strategy side where I showed you how the index that SCHD follows is constructed. Then I went over the sector it is comprised of. I was hesitant whether to include the top 10 companies review here. At the end, I decided that I wanted to keep this video evergreen because literally during my research for the video, 2 of the top 10 holdings changed before I could upload it. For that reason, I have created a separate video you can check on my channel where I analyze the top 10 companies of SCHD. The link for it will be in the description, but do not go there now. We are not yet finished with the SCHD analysis. So, methodology, sectors, companies. This is what an ETF is. And now that we have covered these components, the question that a lot of people will be asking is, what is my overall opinion of the fund? Who is SCHD for, and should you invest in it? Before I tell you, you need to understand that everything I say in this video is my opinion and it's not financial advice. I see a lot of people on social media and YouTube making bold claims and having video titles like buy SCHD or SCHD is the best ETF or SCHD is all you need to retire. First, understand that these people are breaking the law. And second, no one knows whether you should buy a certain stock or an ETF but you. I don't know, your neighbor doesn't know, these guys I talked about certainly don't know. My goal is to give you the education you need to make decisions for yourself, and I will never tell you what to buy. So, with that said, in my opinion, SCHD is a very solid ETF for income investors that want a bit more conservative dividend growth approach with a higher starting yield than you normally get with dividend ETFs that are more concentrated in mega cap big tech names. The methodology of the fund is designed to tilt towards a bit higher yielding stocks, which means that some of them might be a bit troubled, which has sent the share price down, thus driving the dividend yield up. However, the other fundamental metrics from the screening process are going to weed out flat-out yield traps and garbage stocks most of the time. This can be seen by the top 10 companies currently in the fund. All of them are solid businesses with impressive track record. However, don't expect the Apples and Microsofts and Nvidias of the world to appear in SCHD. The screening simply won't allow it. If you want that, there are other ETFs for that purpose. Also, due to the well-diversified sector approach and the focus on higher yielding stocks, don't expect SCHD to have the share price appreciation of funds like Nasdaq or the S&P 500 that are very skewed towards lower yielding, big growth technology names. SCHD is a steady dividend growth machine that has a pretty good methodology, well-diversified sector composition, and solid companies in it. However, seeing what the strategy of the underlying index and the top 10 companies are, I would classify this ETF as somewhere in the middle between dividend growth and current income, because if you remember early in the screening process, the stocks are ranked by dividend yield in descending order. That makes sure that even if a company has better fundamentals, if the dividend yield is towards the lower end of the spectrum, it won't ever make it into the ETF. Now, let's move into what everyone came here to see. Will SCHD make you filthy rich? Just before I do that, it's been a long and detailed video so far, so let me know what your thoughts of it are. I'm aware of the fact that sometimes such a long content does not perform great on YouTube, but at the same time, I want to give you the best value I possibly can. Like the video and leave a comment so that I know whether I should make more videos like that or not. Okay, back to the main question. Will SCHD make you filthy rich? The answer is, as always, it depends. What I can do right here is go into a dividend compounding calculator, throw in some projected numbers in there, and see how the ETF is expected to perform in the future and what your results will be with a certain amount of money you put in. Will this be 100% accurate? No, it never is. But nonetheless, it's fun, so let's do it. First, we need to gather some data for the ETF. We need two basic pieces of information: the compounded growth rate of the share price and the compounded growth rate of the dividend. For the share price, since I could not find it readily available, I will do a quick calculation. At the earliest date for the fund I could find, in the chart, the price had been $24.98. Currently, the price is $69.45. This increase has happened over the span of 12 years. So, if we put this in a compound calculator, the result is 8.89% share price CAGR, which stands for compounded annual growth rate. For the dividend, I will use the already calculated in Seeking Alpha growth of 11.11% for the past decade. Of course, as you can see, for the past 12 months, it has only grown with 5.7%, but as I said, these calculations are never perfect. Now, armed with these two metrics, let's get over to a dividend compound calculator. In the first scenario, we will invest $10,000 once with no monthly contributions, and we won't touch it. Then, we put the data we have for the ETF, the current yield of 3.77% and the share price plus dividend compounded annual growth rates. We will let the dividends be reinvested instead of withdrawing them. And since I have no idea what your tax rate is, where you live, whether you are even investing in a taxable account, I will simply put 10% tax for the sake of having more realistic view and not leaving it at zero. How long will we do it for? Let's start with 20 years. And the results are, by the end of the 20-year period, if the fund continues to perform the way it has been up until now, which it never does, your initial $10,000 investment will have become $112,937. The dividends you will be receiving will be $5,270 per year, giving you 52.7% yield on cost, meaning you'll be making 52.7% of your initial capital every year in dividends alone. Okay, let's spice things up a bit. Let's see what happens on the 30th year. The initial $10,000 became $426,000 and the dividend is $24,000 per year, giving you an yield on cost of 240%. Pretty good. Let's play with the numbers a bit. Let's say you are only going to invest $1,000 every month from your salary without initial starting capital. What would that look like? As you can see, the result is an astonishing $959,000 portfolio worth and $43,619 yearly dividend. This is just from investing $1,000 every month, consistently, without any starting capital. With time, things get really good. Check out the result on the 30th year. Now we're talking. If you commit to investing $1,000 every month for the next 30 years and SCHD performs like it has up until now, you will have a portfolio worth of $3,845,000 with $214,000 in yearly dividends. But we're not done. Let's finally check what happens if you decide to save up a bit more and invest $2,000 in the ETF every month. Your final result is $1,918,000 with $87,000 in yearly dividends. Finally, let's see what the scenario gives us on the 30th year. $7,691,000 and $428,000 in yearly dividends. Pretty impressive. But what if we add $5,000 a month? $19 million. And $10,000? $38 million. And $20,000? Wait, this is getting addictive. You can see how fun this is, and some people really get carried away with it. I have no idea how much these dollars are going to be worth in 3 decades. I have no idea how SCHD is going to perform. Hell, I don't even know if the human civilization will be alive by that time. However, these calculations are not without any value because they show you the power of compounding when you invest in a good asset, reinvest the income you receive, and hold for the long term. It really works like a wonder. So let me know, what are your thoughts on SCHD? Do you invest in the fund? Are you planning to? And what do you think about all the things we discussed in the video? Also, don't forget to check my report on the top 4 stocks and ETFs I invest in for the current economic environment we are in, which you can receive for free to your email address. And before you go, click on the video that will appear on your screen right now to continue with your investing education. Thank you for watching.